Right now, people in South Korea are literally lining up on rooftops. A 43% plunge in SK Hynix stock has wiped out thousands of retail investors, leaving them buried under mountains of margin debt. Western observers look at this drop and see a standard market correction, but that view ignores the sheer scale of the profit behind the crash. Samsung recently posted its strongest single-quarter profit in history, $59.3 billion in cash. That is more than American tech giants like Apple or Nvidia pulled in during their best quarters. These profits are a direct result of South Korea controlling the absolute bottleneck of the global artificial intelligence boom. It is called high bandwidth memory, or HBM. Without these specific memory chips, massive AI models cannot run, rendering Nvidia's processors useless. Only 3 companies build HBM chips at scale. SK Hynix holds 57% of the market, and Samsung controls 22%. America's primary producer, Micron, holds a 21% share. The entire US AI revolution depends on these 2 South Korean companies. Normally, a monopoly on a critical global asset and a record-breaking $123 billion export surplus would cause a country's currency to strengthen. Yet the Korean won recently plunged to a 16-year low, losing 30% of its value against the US dollar. When a nation's defining industries pull in record profits, while its stock market and currency simultaneously collapse, traditional economic rules appear to be suspended. For anyone holding US dollars, South Korea's most valuable tech assets are suddenly sitting in a 60% off clearance bin. To understand how this works, we have to look back to 1997. When South Korea was on the verge of bankruptcy, they accepted a bailout from the International Monetary Fund. The cost of that capital was devastating. The IMF required South Korea to completely open their financial markets, lift limits on foreign shareholding, and permit hostile takeovers. As a result, American capital flooded in. Today, Wall Street funds own massive portions of companies like Samsung and Hyundai, but because these holdings are highly fragmented across hundreds of individual funds, they lack operational control. The South Korean founding families still hold the concentrated voting blocks that decide where factories are built and what technology is shared. Receiving dividends is different from calling the shots. To gain actual authority over these critical AI assets, American institutional capital needed a way for South Korean retail investors to willingly surrender their shares. This process began in 2024. While HBM chips were in severe short supply and South Korean firms were dominating the market, their stock prices dropped by 40%. While the public panicked, Wall Street net bought these shares for 10 consecutive weeks, accumulating massive positions at the bottom. Next came the hype cycle. In the second half of 2025, global financial media launched a coordinated campaign declaring AI memory as the start of a golden decade and positioning SK Hynix as the definitive hidden champion of the AI era. Driven by fear of missing out, South Korean retail investors poured 97 trillion won into tech equities in the first 5 months of 2026. But cash buyers rarely panic sell. At the peak of the market in May 2026, the South Korean government approved a double-leveraged semiconductor ETF, allowing retail traders to play with $2 for every one they owned. Encouraging retail traders to maximize their debt at the top of a cycle removes any margin for error. If the market slides even a fraction, these investors lose everything, while institutional players sit on the sidelines with enough cash to buy up the remains. Just as retail leverage peaked, U.S. institutional capital quietly moved out, selling $110 billion worth of equities in just months. Once the buying power dried up and local banks reached their lending limits, prices began to slide. This triggered cascading margin calls, forcing retail investors to liquidate at any price. In a few days, 300,000 accounts were completely wiped out. These investors understood the macro trends of AI, but they lacked an entry plan, an exit strategy, and risk discipline. By investing on pure hope, they became the exit liquidity for Wall Street. If you want to break out of this cycle and protect your hard-earned capital, you need a proven framework. The Stewardship Finance Academy offers a free stock investment masterclass designed to reprogram your financial mindset. Click the first link in the description below to register today and learn how to identify high-probability setups and avoid margin calls before the program transitions to a paid format next month. On July 10, 2026, the exact day the domestic Korean market was collapsing, SK hynix officially listed on the Nasdaq in the United States. Between the domestic crash and the 30% depreciation of the Korean won, global investors could buy SK hynix shares on the US market at less than 40% of their peak valuation. By shifting the trade to the deepest, most liquid financial exchange in the world, the pricing power of South Korea's top AI asset has relocated. Wall Street now controls the capital, the valuation, and the timing of any future share issuances. Pricing power is only phase one. The ultimate goal is the physical relocation of advanced manufacturing capacity directly onto American soil. Through aggressive new policies, the US government gave global chip makers an ultimatum: build facilities inside the United States or face 100% import tariffs. This diagram shows how that tariff takes a $100 South Korean microchip and doubles the cost to $200, making it uncompetitive against domestic players. To survive, Samsung and SK hynix committed billions to build new foundries in Texas and Indiana. We have already seen this play out with Intel. After they received billions in government subsidies to build domestic foundries, the terms were changed halfway through construction, forcing Intel to sign away corporate independence in exchange for the funding. It is highly likely that Samsung and SK hynix will face similar demands for equity stakes once their US factories are fully built. On paper, South Korea holds over $400 billion in foreign reserves. However, their internal structure is compromised. Household debt has reached 85% of GDP. The domestic real estate market is highly unstable, and bank defaults are quietly rising. This strategy has historical precedent. Through the Plaza Accord and targeted tariffs in the late 20th century, the US systematically shrank Japan's global semiconductor market share from 50% to under 10%. South Korea's high-tech assets are now being rerouted in the same manner. With the capital depleted, the pricing power moved to Wall Street, and the factories located in the United States. The real question is, who is next on the list? Which country possesses the next critical lifeline that American capital is determined to control? We will dive into that in our next weekly briefing. Make sure to subscribe and leave a like to support our independent research, and click the link below to join the free SFA Masterclass today. Until next week, trade safely.